Mentioned, I'm Kristi Buresh. I am the internal wholesaler for the Northeast. So I support agencies in New York, New Jersey, New England, all the way up to Maine. I was actually just in New York last week and spent some time with Charles and some of his advisors. So I don't get out of the home office or out of Nebraska a ton. I'm primarily an internal, I play an internal role, but I do like to get out every once in a while. Charles was very gracious in hosting, so we enjoyed our time in New York last week. I am going to do a screen share. I'm going to go off video. I was just going on video to introduce myself. I feel like the connection stays a little bit better if I'm not on video. Plus, I'm in the home office today. I'm actually a hybrid employee. That's kind of a buzzword in this post-COVID era. I spend part of my time in the home office here in Lincoln, Nebraska, and I work part of the time outside of my home, also here in Nebraska. So anyway, so in the office today, so I'm going to go off of video and do a screen share. All right. Can everyone see my producer workbench?
Yes,
agent portal. Okay, is everyone seeing it? Okay, good, good. All right. So can I find out first then? So I think everyone, because I know Carlos has business submitted. Juris and Patrick, have you been on our agent portal as well?
No, I haven't yet.
You have not. Okay.
No, I have not.
Okay, because you're getting appointed right now. Is that what Charles said? You're in the appointment. Okay. And then Patrick, you've been on the portal, right? I'll just assume that. The reason
Patrick's been on the portal.
Okay, that's what I thought. And the reason I'm asking is I just want to make sure everyone is aware. This is our agent portal. It's called Producer Workbench. It is the starting point for really most of the functions that you're going to be doing as an advisor for Ameritas. We can do many things. We can do our e-apply system, which is our electronic application. We can run illustrations. We can pull product information. We can find really just about anything that you need to prepare yourself for a sale. Most of the things we're going to do is right here under the day-to-day tasks. What I'm going to focus on today is running illustrations. And with running illustrations, I will also kind of guide you into the products and really what the product lineup is and when you would maybe select one particular product over another. Where we're going to go is under day-to-day tasks, we're going to click on Create an Illustration. Under Create an Illustration, you're going to see that there's two tabs. One is web-based illustrations. The other one is software downloads. I always use web-based illustrations. The reason I do that is it's always updated. I don't have to run any type of behind-the-scenes update. When you download software, it does require you to periodically run the update. And inevitably, what's going to happen is you're with a client, you're going to want to run an illustration, and the computer's going to want to update itself, which I always find incredibly frustrating. So as long as you have an internet connection, I recommend using the web-based illustrations. For life insurance and any annuities that we sell here in New York, I should also ask that. Is everyone New York based? Charles?
Yes, on this call.
Okay. Okay, that's why I'll focus primarily then on New York specifics. And then if you were going to run a DI illustration for us, that software is called Illustration Pro. That's specifically for DI. What we're going to concentrate on today is life insurance, which is Life Designs. So we're going to click on Launch Life Designs now. What's going to happen is when you click here, your name is going to fill in automatically where the agent blank is. I have a home office code. That's why you see some gobbledygook there. That is my particular code. You will see your name, and all you have to do is hit login. From this starting point, I recommend clicking on Clients and Cases. Clients and Cases are where you're going to be able to create a client and then run an illustration for that client. So we're going to click on Clients and Cases. You're going to notice that I have a bunch of stuff. I have a bunch of valued clients. I do a lot of training, so I tend to use valued client a lot of the time. If we were to create a new client, what we would do is click on this top right-hand gray box. We would click on New. You would have to fill in something for the first and the last name field. It doesn't have to be full names, but it has to be something. The other thing is it's going to ask for age or date of birth. I always recommend, when possible, use date of birth. We are an age nearest company. So what that means is your clients that are turning their next age within 6 months of today, they are already for insurance purposes that next age. So it's really whatever birthday you are closest to, that is the age we use for insurance purposes. So if you have their date of birth, I highly recommend using that. And then obviously you're going to click on male or female. The address is optional. That is information that's going to show up on the cover page along with your contact information. What isn't optional is the state code. The state would default to your home state. If you happened to have a client outside of the state of New York, it would be really important that you change that state code because then you're looking at products in that particular state and not in New York. After you type that information, you would hit return. I'm going to go ahead and hit cancel just because I have so many, as you can see. Let's see here. Let's find somebody. Let me go to I'm going to go to a 45-year-old. Let's see what state code I have here. Here's a Connecticut. I'm going to change it to New York really quick. So here's a 45-year-old male. I'm going to go ahead and use that for purposes of discussion. You can see that I've ran a lot of illustrations. When it says show cases, these are all the different illustrations for that particular individual. To run a new one, you'll click on the bottom right-hand side gray box. You'll click on New, and you'll hit Basic Illustration. This is going to be really a guide of drop-down arrows, and those drop-down arrows are going to be things you need to select to really hone in on what illustration you want to ultimately run. So the very first drop-down arrow shows the categories that you're going to pick from. Are you going to run an annuity illustration, universal life, index universal life, whole life, or term? We're going to go ahead and start what I consider to be kind of the entry-level product to most insurance carriers, and that's going to be our term product, which is the Value Plus term. So I'm going to select term. The next drop-down arrow, because we have the whole life contracts and the term together, that's why you see whole life and term listed. We're going to go ahead and select term. Okay. On the illustration for term, you can select up to 3 level term periods. We do offer 1-year term, 10, 15, 20, and 30, depending on your client's age. Again, you can select up to 3 for one illustration. So I'm just going to select 3 level term periods. The next drop-down arrow is the classification, and this is from an underwriting perspective. This goes in order of the least expensive premium to the most expensive. The only time you would have more expensive premium than what's on the list here is if you had a client who was table rated as a substandard risk in our underwriting department. Those would be table ratings. For every table rating that a substandard risk is assessed, it's typically about a 25% increase in standard non-tobacco or standard tobacco costs, just depending on if they're a tobacco user or not. So I always tell people, you can actually assess your client based off of our underwriting guide. That is something that's available on Producer Workbench. You can just search underwriting guide, and that will help break down the parameters of what a client has to be to classify for Preferred Plus, Preferred, Select, and Standard Non-Tobacco. I'm going to go ahead and just, this is my client, right? So of course he's the best. He's Preferred Plus. So I'm going to go ahead, that's a joke. I'm going to go ahead and select the top one just for quoting purposes. I'll make him a Preferred Plus risk. On the next line, input face, we're going to type in the death benefit that we want to quote. We're going to say that this gentleman would like $500,000 of term insurance quoted. The next field is the mode. If you want to quote this annually, semi, quarterly, or monthly, you would select it from there. The next thing is down at the bottom. You're going to see two different discounts listed. Employee discount, that's really only going to be relevant to you and your immediate family. If you, as an advisor of Ameritas, were going to write term insurance on yourself with us, you do qualify as an advisor, as basically an employee. So you could use our employee discount if you wanted to. You could click that. Now just do keep in mind, anytime you use our employee discount, there is an adjustment in compensation. So you would just want to be mindful to check out the particulars. What doesn't affect compensation is this next discount, which is the same payer discount. This one I absolutely love. Basically, if you have two individuals buying term insurance or two individuals buying life insurance that has a policy fee, or a combination of DI and term insurance. We offer a lot of combos for this discount. What it does is it takes the policy fee on the term insurance and it cuts it in half. So instead of an $80 policy fee annually, it ends up being $40, which actually in the term world is a big savings. So if you had two spouses, like I said, if you had two life partners, if you had two business partners, this is something that you could go ahead and select. It would give them that discount that I speak of, and again, save them a few dollars. If you were interested in adding riders to this coverage, you would click on our Riders tab. That's on the left-hand side. What's automatically selected is our conversion extension rider and our terminal illness rider. Conversion extension, what that does is gives our basic convertibility period, which is base coverage 5 years. But if your client wanted beyond a 5-year conversion period, you could add the conversion extension rider. So conversion basically means you're taking the term insurance and exchanging it for permanent life insurance. No underwriting is required. They just have to pay the new premium of the new permanent contract. They get to basically hang on to that original term insurance underwriting class, which is really a nice thing because we all know that life happens, our health changes over time, and as we get older, obviously it's a lot easier to, come down with different health conditions, changing our underwriting class. So that conversion extension rider really locks in that underwriting class for the level term period or age 70, whichever comes first. Terminal illness rider, that is a free rider. What that does is if your client does get diagnosed with having less than a year to live, it does give them opportunity to advance up to a large percentage of their death benefit, and they could use that while they were still alive. The other cost riders Excuse me, I'm tackling just a little bit of allergies, I think, this morning. So one moment. My apologies. I'll have to stop every so often and take a drink. The first cost rider available is waiver of premium. This is something you could add if the client were to become disabled. We would go ahead and waive the term premium for them. Accidental death benefit just pays an additional benefit in case they die of non-natural causes. And then the children's rider, which that provides $25,000 of death benefit on each covered child of the insured. So for instance, whether they had one child or 5 children, one rider would provide $25,000 of death benefit on each of their children, and children that are born new to that insured. Once they are 15 days old, they would be automatically covered if they have this rider. What's nice about it is when that child reaches, or each child reaches age 25, you can actually convert the rider up to 5 times the death benefit amount for that child. So a $25,000 rider becomes $125,000 permanent coverage without going through insurability. So I think that's a really cool rider for any of your clients that do have young children. We'll go back to the policy there. So again, I've selected up to 3 term quotes. We're going to hit preview. The preview button is what launches the illustration. And what this shows you is what you are purchasing, or what you're proposing to purchase. It is a value plus term. The client's name would be listed under the present to, your name and address and any contact information when you're licensing with when you're appointing with us, our licensing department, whatever they data collect, that's what shows up here in the presented by. Then you're going to get a comparison quote. Remember, I use same payer discount on this gentleman. I like this part of the illustration. This is at the end where it gives the side-by-side monthly premiums. So if we were going to offer this gentleman 10-year term, it'd be basically with the conversion extension rider, $33 a month. I'm ignoring the change right now. 20-year term would be $54 a month, and 30-year term would be $90 a month. Now that does assume he is preferred plus. Remember, that is the category that I chose. Excuse me. And so what's nice about this is that premium, again, would be level for that entire term period, whichever one you chose, and convertible because I did put the conversion extension rider on until the end of that level term period, or age 70, whichever comes first. So this is a term quote. Before I pivot over to whole life, are there any questions on term?
Hey, Kristi, I have a question.
Yes, Carlos.
It was just about the conversion rider that you were talking about with the children's conversion
Yes.
rider. Can you explain that? Because you said it does convert to, does it convert to a whole, and when do you input the children, or where do they show up on the application for the policy?
Okay, so basically, and if you convert, first of all, you'd have to select the rider, right? So to quote it, we would have to select it. So all that does is give the pricing on this term quote. When you're on the actual application, you will select the children's insurance term rider. On our application, then it would ask for the data. So when you're in eApply, you would select that rider and you would collect the information on the application at that time. Then what happens is they're covered, right? You have a policy, and once that child reaches age 25, it has that individual has the opportunity to convert to whole life, universal life, or index universal life, because we offer all 3 permanent life insurance types. So it doesn't have to be whole life. It could be, if you wanted it, whole life, UL, or IUL, whatever permanent plans we're currently selling. And just to show you really quick, I wanted to show you what it does to the price. So there is now you can see on the screen, I've now added the children's insurance rider. What that does is adds an additional $12.50 a month to their premium. So what that $12.50 does is, remember, it stays level for their entire term period, and it does cover all children. I always want to make sure people know that. It's not $12 per child. It's $12.50 for the rider, and that rider covers all natural and adopted children of the insured. Does that answer your question, Carlos?
Yes, I got it. Yeah, perfect. I wanted to see that.
Awesome. 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 No, it's a great rider. I used to never think as much about it until I became a mom years and years and years ago. And then I ended up having one of my children as a young adult is actually uninsurable. So I didn't really think about the impact of what that does, because now he's married and has a child. And, thank goodness he's got insurance that he put in place on, I did it, put in place when he was young enough, when he was insurable. So my point is, there is something impactful about that rider, because you're putting it on young children, knowing that they now have some type of insurance coverage that they can have the rest of their life. So it's pretty cool. I think it's a neat rider. And then also remember, any new kiddos that are born to that insured are covered as soon as they're 15 days old. So kind of a neat thing. Any other questions on the Value Plus term?
Yes. So you just mentioned just now that when you add a child to as a rider, they have it for the rest of their life, even if it's a term insurance?
Because they have the conversion privilege. That's what I meant by that. I'm glad you picked up on that. So yes,
Okay.
It's term, but when that child reaches age 25, they have a decision that they can make. And if they don't exercise the conversion right, then you're right, it's term. It drops off. They won't have the coverage anymore. But at age 25, they can convert and get their own policy for up to 5. They can choose, the maximum is 5 times the 25,000 of coverage, which happens to be 125. That's what I meant by coverage for their lifetime, because they can convert. Yeah, no, good catch. I'm glad you caught my words. That's perfect.
Okay.
And is there
So
a time
remember,
period?
go ahead, Harry.
Is there a time period to when you could is there a time period for the conversion? Do you have like a specific time you could convert, or they give you a time if you don't convert, you use it, you lose it?
You're right. Okay, so good question. It's convertible anytime for the 25,000 of coverage. So check this out. So at any time, the child can convert for the 25,000 of coverage and get a $25,000 permanent policy. If they want the 5 times, that has to be done at age 25. It is a limited window, Harry, and it is for their age 25. It's one of those things that you'd have to actively manage on your client's policy and make sure they know that when that child has their 25th birthday, because remember, they're covered until age 25 once they're on as a child's rider. If they don't convert at age 25, they lose the conversion privilege. So it is a sharp window. It is age 25 of that child.
What about an adult? Can an adult buy like $1 million term life and in 10 years decide they want to convert some into whole life, or it doesn't apply?
Now that's different. That's different. Yes, that is your policy conversion as an insured. So that, great question. So that, if you don't add the conversion extension rider, we offer a 5-year conversion period. But for that little bit more money, you add the conversion extension rider. That extends it all the way out to the end of the level term period or age 70, whichever comes first. And you can convert up to your full term amount to any of our permanent policies, any of them. We even give the client a kicker. We give them a term conversion credit equal to what they've paid in the last 12 months of term premium, and we'll use that as a premium credit on their new permanent policy. So yeah, Harry, it's a great question. So yes, our Value Plus term is fully convertible to any of our currently sold products. And again, you will get up to whatever, like you said, if they bought $1 million term, they can convert for up to $1 million of permanent coverage.
Okay.
One more. I apologize to interrupt, but where
No,
is it?
that's why this is for you. What's your question?
Where is it that you would select? Or
Thank you.
Is it automatic? Automatically
You're
done?
welcome, Jerissa.
Oh, yeah.
I'm sorry, Carlos. Is what automatic?
Is the convert, like, where would you select to let's say that $1 million policy, somebody bought the term, and I guess it would be at the end of the term that they want to convert it. Where do you select it, or is it just automatic?
Yep, that's a great question. No, it's not automatic. Okay, that's a great question. It's not automatic. And you don't have to do it at the end of the term period. You just that's your last chance, is the end of the level term period or age 70. Whatever time they choose to convert, what you do, Carlos, is fill out conversion paperwork. Think of it as a service request form because there's no underwriting. So it's really as simple as, I'm really simplifying the process, but you basically say, here's my policy number. I want to convert to whole life. You run the illustration for them so they know how much the new whole life contract's going to be. They sign it, they date it, and boom, send it in to us. And we exchange their term policy for the new permanent. It's actually a really simple process.
So let's say somebody had that as an intention. Let's say they purchased $1 million, and then you'll know that they were going to convert it. So would you tell them, hey, if you convert it at this point in time, you would really want to know what the premium was, right? And
absolutely.
I think how do you do that part? And can you go? And can you choose? I guess you could always choose less than the $1 million, right? You could go up to $1 million.
Exactly. Yep. Up to $1 million. Yep. So these are all great questions. So basically, how you know what it's going to cost is you run an illustration. Because remember, when you convert, you're now, like for the person on the screen, this is a 45-year-old buying term insurance. Maybe he converts at age 50. Well, then he would have to pay 50-year-old whole life. Let's assume he wants whole life. Then you have to run him 50 as his age, and whatever death benefit he wants, no more than the term amount. You can't exceed, for this one on the screen, you can't do more than 500,000, but you would just run a whole life quote. Now, if he doesn't convert at 50, he waits till, let's say, 55. Well, what happens? He's now going to have to pay 55-year-old whole life term rate or whole life rates. And let's be clear, life insurance gets more expensive every year that you wait. Every year that you wait, your insurance costs are going to go up. That's just the nature of our industry. And that's why people like to buy term like this, right? Or you know it's going to be cheap, you're locking in for the entire term period, but term expires. And if the level term expires, it does go to what's called annual renewable term, which is very, very pricey, very pricey. So it's in the client's best interest. If they want to have coverage beyond their term period, the sooner they can convert, the sooner they're going to lock in lower permanent rates. Does that make sense? The sooner you convert, the quicker you're locking in a lower rate. Every year that you wait, the cost just keeps going up, but yet you have the term that was cheaper. So it's one of those things where you really have to analyze it for each client to see what's best for them, that they can convert. And I'm losing my train of thought now, up to the term amount. So did that answer your question, Carlos? Oh, go ahead, Charles.
Kristi, can you show them real quick on that illustration on the policy data page what the premium would jump to? Because it's on that illustration.
Oh, sure.
And that's usually enough to get people to pay attention when you have the conversion conversation. I'll go right to this page.
No, perfect. Yep. I will open that right back up. So down here, so remember we've got a 10-year, a 20, and a 30 side by side. So remember when the 10-year expires, there's your new annual renewable rate. So if he only bought 10-year term, whoops, it goes to from $500 some annualized to over $7,400 a year. If we bought 20-year term at his age 65, that ART goes up to $17,000 a year. And remember, that's just the first year. It goes up each and every year, as you can see on this ledger. And then check out this 30-year term, and he is 75. If he let it go to ART to keep it in force, he'd have to pay $51,000. That's a lot. So the ART knows, we know that they have coverage available, but let's be honest, it's not affordable. I mean, annual renewable term at that late in the game is going to be pretty pricey. So like Charles said, if you show them what these rates would go to if they still wanted coverage, it might, you know, incent them to look at permanent coverage maybe sooner rather than later on that potential conversion. Nope, that's awesome. Any other term questions? You guys are asking great questions. I appreciate that.
I have a question.
Yes, sir.
Yeah. So during the conversion time, if a client asks you, will there be any kind of cash value because of even though it's a term, but if you're converting, the cash value gonna start from right from after the conversion, right? There'll be no cash value, right?
Well, there's no cash value from the term. The term doesn't build any cash value, but when they convert and start paying into their new permanent contract, that will start accumulating value, but not until they do the conversion.
All right.
Is that
Thank
what you meant?
Yes. Yeah.
Okay.
Thank you.
Yep. No, that's a great question. Any other term questions? Because I'll pivot over to whole life next.
Just one more for the children.
Absolutely.
I had to put gas, so I don't know if maybe someone asked this. So, you know, do we have to do blood work and urine for over 100 in this company?
Okay, I lost for the children.
Yeah, so when you add a child on the policy, do we have to also do, because I don't know if again, I'm new to this company.
For children. Yeah, no,
Okay.
we do not require lab work on juveniles.
Okay, all right, perfect.
Yep.
All right,
I wasn't sure what you were asking. At first I thought maybe you were asking for the parent. And that is possible. I mean, depending on if you do accelerated underwriting or traditional underwriting, that's different. You know what I mean? I wasn't, thank you for clarifying. No, children do not have to do blood and urine. That's a great question.
Okay.
Okay. No, those are awesome questions. Thank you. So what I want to do now is change from quoting term insurance to quoting whole life. So you'll notice here that we have different whole life contract names here. Value Plus is going to be what I consider our staple whole life contract. It is the least expensive of the 3 whole life contracts that we offer. So more often than not, if it is someone who's price conscious on their whole life contract, then you're going to want to start with Value Plus. If someone was willing to pay a little bit more premium and had long-term cash accumulation as their focus, you could look at the growth whole life contract. That again is going to be a little bit more expensive than the Value Plus, but it has that long-term cash accumulation focus. And then another kind of step up from there is the Access Whole Life. The Access Whole Life is geared toward early cash accumulation. So it's one of those things where if you wanted early access, we've got some people that borrow money early on from their whole life contract, and they want as much value as possible quickly. That's where the word access, you would think the access product. More times than not, a good just protection-based sale, you're going to be using the Value Plus. So 3 different names: Value Plus, least expensive whole life. Growth, going to be a little step up in premium from there, but it builds more long-term cash accumulation. And then you'd have your access whole life, which would be geared toward early cash value access and accumulation. So we're going to go ahead and just pick the Value Plus. We're going to keep my same 45-year-old gentleman here. I'll keep him Preferred Plus. You'll notice that the death benefit defaults there to $100,000. $100,000 is the minimum if you had somebody better than a standard. So if they were Select, Preferred, or Preferred Plus, $100,000 would be the minimum death benefit. If you pick Standard non-tobacco, now you're able to go down to $25,000 if you did traditional underwriting, or traditional path, or you can even go as low as $10,000 on the Value Plus if you were looking at our final expense or our low band of ratings. So the $10,000 to $24,999, we call that our low band. It's simplified issue. Less medical questions are asked. There's never any lab work required. It's just one of those small death benefits that would be available to an insured for, like I said, the least amount of underwriting effort. It still obviously is underwritten, but again, it's a more simplified, streamlined application and a more streamlined process. Our traditional pricing and underwriting starts at $25,000 of death benefit, so just keep that in mind. Remember, if I want him at Preferred, I have to stick with that $100,000 minimum death benefit. If I was going to quickly, like without any riders, I'm going to click on riders. I can't remember if that child rider would stay on here. Yep, remember we selected the child term rider on his term, so it's still on to quote, which I'm going to leave it. I think there's nothing wrong with that. So if we were going to just want to quickly get a whole life quote for him, if I hit this quick calc button, it's going to give me just a real quick synopsis. For $100,000 of Value Plus whole life, on a monthly basis, it would be $145 for this 45-year-old gentleman. Now remember, I do have the child term rider, and that does cost that. It's the same on, the cost is the same on any of our products. It's a little over $12 a month. So if we took that child's insurance rider off, it would decrease the premium by about $12. Other than that, this gives you, without going to the ledger, this gives you a quick, kind of that quick pop-up to tell you what the price would be. And if you're like, oh yeah, he said he could do a little bit more than $145, right here we could just up the death benefit again. We could hit quick calc again. Okay, $150,000 would cost $210. That's something that's more in his price range, what he was willing to pay. If he wants as much coverage as he can, that's probably the way. So if he told me he could spend around $200 a month, I'd probably stick with this one right here. Value Plus is going to be the least expensive. Remember, if we change contract names, it's going to get more expensive. If we pick a growth, it'll be a little bit more money. Access would be more as well. This would be, like I said, kind of an entry-level whole life contract. Nothing bad with it. It's just, again, it's more death benefit focused. If we were going to add any other riders, remember, we'd want to go back to that riders tab. We already talked about this with the term. Waiver of premium, accidental death, children's insurance rider. Now, because we've pivoted to whole life, we've got more riders available. If you wanted to add, check this out, level term on his whole life contract, we could go ahead and select level term here. You could select that rider. Whoops, I meant to click the box. We could click the box. We could pick a dollar amount of death benefit, and then we could do 10, 15, 20, or 30-year term. A little note is whatever year of term you pick here, I recommend having your ending to age be the same amount of years out. Otherwise, do you remember what I told you and what we looked at? What happens to level term? What happens to the premium at the end of the level term period? Remember how it skyrockets to annual renewable term? It will do that on a whole life illustration as well if you don't click an end age like I did right here. So if he wanted to bump up his death benefit just a little bit more, we could add that 50,000, and again, it doesn't have to be 50, it could be 100, it could be 200, it's however much he wants to purchase. If he wanted to overfund it, put additional monies toward the cash value, he could use the flexible paid up additions rider. Excuse me, this allows overfunding of a whole life contract. It does have immediate access, it does give you an immediate bump up in the extra cash value and additional death benefit. Guaranteed insurability rider, this is grayed out. It's grayed out because he is too old to get the guaranteed insurability rider. If he was younger, this is something you could add that would allow your insured to get additional coverage at certain points of their age, at certain points along their lifetime. They could get additional coverage without going through insurability. Care for Life, this is a no-cost rider. This is our living benefits rider. I will look at this in more detail when we launch the illustration. So from here, I'm going to hit preview. And we got a lot of stuff going on here, so we'll kind of step it through. First thing, we still have our cover page. Now, this is going to be a neat starting point for a permanent illustration, in my opinion. This gray box summarizes what you are proposing to the insured. What exactly are they looking to buy? In this gray box, it talks about their protection, which would be their total death benefit, right? That'd be $200,000. Now, why is it $200,000? We have 150. Remember, I put 150 on the first screen, and then I added 50,000 of term just to show you. It only took the premium up from, do you remember it was $210, right? Well, now it's only $213. So it only added $3 a month onto the quote, but he did go from 150,000 up to 200,000 because of that 10-year term. It talks about the cash value. It talks about what the guaranteed rate is. Over here, it'll talk about dividends. We are a dividend-paying company. Dividends are not guaranteed, but we have always consistently paid them. Anytime that we offer a dividend-paying contract, we've paid dividends. We have not ever not paid. It's just they are absolutely not guaranteed. So that is something that could be foregone in 1 year or a couple of years, but I've never seen it happen. The living benefits, this is our Care for Life rider. We'll look at that in more detail. This will give them access to a portion of their death benefit if they become critically, chronically, or terminally ill. This is something that's a big buzz in the industry today because people are seeing what the costs are to maybe, to their parents, their grandparents, aunts, uncles, they're seeing when people need long-term care type assistance, it's expensive. And this just provides another asset that they could possibly draw money from. If they become critically ill, we know that health impairments and conditions can really devastate a family financially. So this just gives them another bucket of money to be able to draw from. So with this Care for Life benefit, we will offer 25% available of the permanent death benefit if they become critically ill. 50% is available for chronic illness, and 75% is available for terminal illness. The definitions is on the next page. So if you look at this list of impairments, these are the things that if this happened, I mean, who doesn't know someone who's had open heart surgery, right? We all do. We all know someone who's had open heart surgery, so we know it happens. We all probably know someone who's had a stroke. I mean, these are critical illnesses that unfortunately happen, and if they do happen, know that the client has access to accelerate some of their death benefit. So what happens is if they do accelerate it, we use it, we treat it as almost like a loan against the death benefit. So at time of death, the amount that we accelerated to the owner plus interest would come out of the beneficiary's proceeds. So I always say the person that actually ends up paying for it is the beneficiary because it comes out of the death benefit, but it is a free rider to have on the contract. And if you don't use it, no harm, no foul, the beneficiary's death benefit would remain intact. Now that's the critical. The chronic, this is the one that is more long-term care-ish. This is not long-term care insurance, but it looks and feels like how a long-term care policy would maybe function, in the fact that you have to be unable to do 2 of the 6 activities of daily living. And if that happens, you can advance up to 50% of your death benefit. And that's huge because, you know, I know Charles knows this about my family, but, you know, my dad suffered from Parkinson's, you know, full on the last 10 years of his life. And it cost a lot of money to make modifications to the home and just to care for him. My mom was his caregiver, and if they had had this type of contract, there would have been money that they could have pulled from to help offset some of those costs. So anyway, here's the illustration. Know that on a whole life quote, you're looking at guaranteed columns and non-guaranteed columns. So whole life guarantees are the name of the game, right? This is why people gravitate. And if they love whole life, this is why they love whole life, because the premium's guaranteed, cash value is guaranteed, and death benefit is guaranteed. You will see that all the way through this contract, all the way down to age 121. You'll see that the cash value endows to the death benefit amount, and that's the worst case scenario. So they've paid their premium. They know no matter what, they've got a guaranteed death benefit. On the non-guaranteed side, we do offer, you know, dividends, remember, so you are going to see some increases in the death benefit. That's because when I ran this illustration, I'm using the dividend to purchase paid-up additions. Those paid-up additions are increasing the cash value and buying more death benefit all at the same time. So that's why you see an increasing death benefit. Now, why did the death benefit drop here from 200 to 150? Who remembers? What did I add on to this contract? Why does it drop from 200 to 150? Who remembers? I'm going to take a drink. I'll let you guys, whoever knows the answer. Somebody was paying attention. I know it. What did I add as a writer for 10 years?
You want me to answer?
I would love for you to answer,
writer,
Charles.
Right?
That's right. Yes. I added $50,000 of 10-year term just to have as a writer right on the contract. What happens is it's 10-year term. If you don't convert it right to its own policy, it's going to drop off. So that's why this particular illustration drops from 200,000 to 150, because I did show 10-year term as a writer. Wouldn't have to. I could take that, or I could take that 10-year term and buy 30-year term instead. I'm just showing you the flexibility of our contracts and how you can really tailor make this to fit your client's needs and objectives. Okay. I've been talking. I'm going to drink some of my tea. What are your questions on whole life? Was I that good? Charles, I bet you've got something to add on this.
No, I don't have any questions, but I was wondering if we had time where you could show the Access Whole Life so they could see the difference between the cash values. Did you see how the cash
And
value
remember, it's gonna
doesn't really start to get going
Sure.
on this? This one is low cost, but the cash value doesn't really get started until the
Right.
third year. But
because it's protection, right?
the access whole life will
Right.
give cash value in the second year. So I don't know if we have time to go through that really quick.
Yep, I can show that real quick. Yep, no, but let's also have everyone take note of what the premium was. So $213. And like Charles said, this is a protection focused product. So yes, it's building cash value, but not at a ramped up speed, that's for sure. So if I go back, I'm going to leave these riders on because I'm going to do apples to apples here. And all I'm going to do is change it to the access. That's the only thing I'm going to do is change product. And if you notice, the riders are still the same. I'm going to leave those on. I'm going to hit the preview button and we'll take a peek. All I did was change product to something that builds early cash value access. So let me go right to the ledger so we can get to the meat. Okay, so first of all, notice that our premium jumped up. So about $100. Now, why did it jump up so much? Because first of all, this is a limited pay product. You only pay premiums to age 75. So this is paid up in full at age 75 versus what we just looked at, which is lifetime pay. So that's one thing. And like Charles said, this is cash focused. So now we've got a bigger chunk of money available right away in year 2. That's why you're seeing quicker build up, quicker access. So you're paying more, but you're getting more. You're getting more cash value and you're getting a policy that pays up quicker. But remember, it's more expensive. So it's one of those things for the right client. This is a perfect product. That's why I like to always say we offer a variety of solutions because we know there's a variety of clients out there with a variety of needs. Any whole life questions?
Yeah, I did
Yes,
see
Carlos.
I do see the difference in the build up in cash because year 10, yeah, Cal was trying to calculate. They would have paid probably approximately 32,000, and then they would have cash value of 26,550 built up, which is pretty good. I mean, and then on the other hand, I calculated as well. It was a lot less. But my question was, you said the dividends are not guaranteed. What do they base the dividends on? I mean, you said they paid it. You know, you haven't seen it when they have it, but
Yeah, they do. Well,
Yeah.
you know, the thing is, you know, you've got mortality, you've got expenses, you've got the guaranteed interest rate. You know, you have all of that that goes into this value. And we, like I said, we are a dividend paying company. I know I said they're not guaranteed because they're not, you know, per the contract, they are not guaranteed, but we have consistently always paid dividends to our policyholders because we are a mutual company. We're a very strong mutual company. You know, we're in business for our policyholders. And so it is one of those things that we take very seriously. But this one, like you said, it's a little bit more expensive as far as premium out of pocket, you know, but you're building, like I said, that value quicker. And again, it's paying up quicker as well. So 3 different whole life contracts. Well, we didn't get to today, but we've got another session scheduled Monday morning. What we'll do Monday morning is concentrate on IUL and UL, if that's okay with everyone. I appreciate everyone's time today. We have a couple more minutes. I am going to quit sharing my screen. Any last minute questions?
And the dividend what happens to the dividend once it's paid? It goes back into the policy?
Well, you have choices. That's what's great. You have choices. I want to say there's like a half dozen different choices on those dividends. our software is defaulted to have the dividends by paid up additions, but by all means, I mean, if you want to take them as cash, take them as cash. I mean, there's different things you can do with our dividends. That just happens to be the default for the illustration software. But it's like with most whole life contracts, you do have choices of what to do with your dividends.
Okay.
Now,
And I
there's information on dividends on Producer Workbench that we can share with clients or.
Yep,
Okay,
and there's also when we and remember, I want to say there's like 6 different. I always have to read the list because the default is the paid up additions, but you can take them as cash, you can reduce premiums, you can accumulate with interest, you can buy 1-year term insurance or reduce an outstanding loan. Those are your 6 different choices of what you can do with your dividends. The most common, I would say 99.5% of the illustrations I run, people just use it to buy paid up additions, to buy more life insurance.
And I don't know if somebody already asked, is there a blood work requirement for certain amount of life insurance policies?
We have a couple of different paths and underwriting. Yeah, we didn't go down an underwriting path.
Well,
I'm not an
Kristi-
underwriter. I can go ahead, Charles.
Well, Kristi, on the session Monday, in addition to IUL, can you go through the underwriting? Because I think that's where we get we struggle with the underwriting because there's so many different programs and how to get them through. Like
Sure.
she won't be able to go through
the
that in 1 minute. Yeah.
Yep, not in 1 minute, correct. But we can talk about, because yeah, IUL won't take that long to go through because it takes the longest going through the first couple of product types. And then, as Charles knows, I am not your underwriter, but I do know the programs, and I can definitely get you started on the basics. We can go through that. Absolutely. Absolutely. Okay. Well, it is straight up on the hour. I appreciate everyone joining today. Everyone have a great, well, tomorrow will be Friday and then a great weekend, and I'll see everybody Monday morning.
Hey, thank you so much, Kristi. Appreciate it.
All right.
All right.
Oh, you bet. Take care. Bye-bye.